All right, fellow AMC stockholders, XMAX Trading here. Just want to go over some pretty interesting DD regarding investigation into short sellers. So if you like the channel, subscribe to the channel and hit the like button. Let's get started. So the U.S. launches a criminal probe into short-selling hedge funds. This is from Al Jazeera because all the Bloomberg, all these other were like a paywall. So found on Al Jazeera, but U.S. launches a criminal probe into short-selling hedge funds. Department of Justice digging into how hedge funds tap into research and set up their bets. The U.S. Justice Department has launched an expansive criminal investigation into short-selling hedge funds and research firms, scrutinizing their symbiotic relationship and hunting for signs that they improperly coordinated trades or broke other laws to profit, according to people familiar with the matter. The probe, run by the department's fraud section with federal prosecutors in L.A., is digging into how hedge funds tap into research and set up their bets, especially in the run-up to publication of reports that move stocks. Authorities are prying into financial relationships between hedge funds and researchers, hunting for signs that money managers sought to engineer startling stock drops or engage in other abuses such as insider trading, said to the people asking not to be named because the inquiries are confidential. Underscoring the inquiry's sweep, federal investigators are examining trading at least several dozen stocks of well-known short targets such as Luckin Coffee, Bank of California, Malandark, and GSX, and they're scrutinizing the involvement of about a dozen or more firms, although it's not clear which ones, if any, may emerge as targets of the probe. Toronto-based Anson Funds and anonymous researcher Marcus Aurelius Value are among the firms involved in the inquiry, the people said. Other prominent firms that circulated research on stocks under scrutiny include Carson Block Muddy Waters Capital and Andrew Left's Citron Research. The U.S. probe opens yet another front in already treacherous era for those trying to profit on stock drops. Some bearish funds threw in the towel as government stimulus buoyed prices during the pandemic. The pressure intensified as retail investors organized counterattacks on popular short targets. Hell yeah! Hell yeah! Bidding up shares to inflict losses on hedge funds this year. By late January, Citron vowed to give up short-selling research and focus on long bets. Meanwhile, companies criticized by short sellers have become increasingly bold in firing back, sometimes launching legal battles even as they face government probes that ultimately support short sellers' thesis. A number of corporate executives have been hoping U.S. authorities might help to further shift the focus to investors' tactics. Still, successfully bringing up charges against short sellers could be challenging, given that betting against companies and publishing research believed to be accurate is lawful and even beneficial for markets. So far, nobody has been accused of wrongdoing, and authorities may ultimately decide not to pursue charges. Government attorneys are trying to determine whether short sellers engage in some form of deception by misleading the public about their financing, or what appears to be independent researcher violating confidentiality agreements with authors and orchestrating stock plunges to panic shareholders and exacerbate selling. Spokesman for the Justice Department and Muddy Waters declined to comment. No response from Anson Funds and Aurelius. An attorney for Citron, he's aware of the industry probe. He expressed doubt, whatever. Citron Capital and Mr. Left are successful because they do quality research and keep their reports secret from other short sellers until publication, said the lawyer. There's simply no truth behind any theory that short sellers coordinate among themselves. No truth. Sounds like a Soviet thing. Among themselves for professional research, at least in regard to publications by Citron and Andrew. Uh-oh. I'm hopeful that anyone investigating the issue will consider that conclusion as soon as possible. Why you want them to reach that conclusion soon? Oh, come on. Funding research. Hedge funds are known to strike a variety of deals with researchers and sometimes paying handsome subscription fees for fresh insights into corporate trouble, or even become the author's primary source of funding. That's a conflict. And one example, prominent financial investor Harry Markopoulos, who normally makes money from whistleblowing awards, said he partnered with a hedge fund to share profits when he released a report on GE. Some hedge funds have been known to suggest targets for researchers who then deliver scathing reports. One cautionary tale emerged in court after Dallas-based SaberPoint Capital agreed to pay a short-selling researcher a monthly retainer of $9,500 in 2018. SaberPoint encouraged him to dig into real estate company Farmland Partners. The researcher also publicly wrote under a pseudonym, later published an article on Seeking Alpha. Whoa, Seeking Alpha is implicated, setting off a 39% drop in farmland share price. The company sued and used a judge to force him to reveal his identity, Quinton Matthews. Matthews later said in a statement that he subsequently learned his article contained inaccuracies and false allegations and retracted it. He and Farmland reached a settlement. Saber Point said it didn't know about the Seeking Alpha article. BS. Farmland is also on a list of stocks that the Justice Department is examining, and the lawyers declined to comment. The unit handling the inquiry already has a formidable reputation on Wall Street. It recently brought several cases against global banks and traders for illegally spoofing precious metals and treasury futures. As part of that probe, J.P. Morgan paid more than $900 million in penalties after its traders placed and canceled orders on commodities to benefit positions held by the bank or prized hedge fund clients. Those cases were brought by analyzing trading data for suspicious patterns and attributing it to individual traders. While prosecutors in short-selling investigations issued subpoenas as recently as October, the effort has been underway much longer, people said. The inquiry gained momentum after U.S. lawmakers called for more scrutiny into the meme stock trading frenzy that erupted in January. Single weekend that month, retail investors sent the price of GameStop soaring more than 700% before brokerages began limiting bets. Some organizers of the buying spree claim hedge funds have been unfairly using their market clout to drive down stocks. Unfairly using their market clout to drive down stocks. I mean, the reason why it shot up 700% is because of naked shorts, right? I mean, retail by itself can't do that. Lawmakers have since held multiple hearings on the fracas, at times discussing whether to force short sellers to boost disclosures. Concerns about how short sellers carry out attacks has risen repeatedly over the years. SEC and the JD have gone after hedge funds for running short and distort campaigns. Basically, a practice involves setting up bearish bets, releasing misleading and inaccurate info, drive the company price down before closing the position for a profit. But there are also concerns about the impact of earnest reachers can have when sprung by surprise in the market. Studies by Columbia University law professor Joshua Mitz have found that short sellers' reports can briefly induce bouts of panic before the shares rebound. In those jittery moments, sometimes minutes or hours, well-positioned short sellers can cash out trades and pocket significant gains. That's why they're doing this, because they're making a lot of money from shorts. Mitt examined more than 1,700 reports made by pseudonymous short sellers from 2010-2017. They concluded that they contributed more than $20 billion in dislocated value or temporarily misplaced stocks. Academics have encouraged U.S. authorities to address the possibility that short sellers are laying out their case against stocks, then using the impact of that news to reap gains and quietly move on. Last year, Mitz and about a dozen other prominent securities law professors urged SEC to write rules requiring that short sellers who voluntarily reveal bets against a stock be required to disclose when they've exited the position. The professors also asked regulators to write a new rule that would make closing a short position immediately after sending a negative report with the intent of doing so upon publication constitute market manipulation. Yeah, I mean, if you close a short position right after a negative report, right, causing the effect that you want, then this could be market manipulation. We don't know what's going on behind closed doors. We all feel like SEC is not doing a good enough job. They're either hiding, they're not doing it, they don't want to do it. I don't know what it is. The Justice Department is involved, so hopefully they're investigating this. But we don't know. It could be a while before we ever find out. So, because they try to keep these investigations hidden until, of course, it came out. Somebody talked about it. So, anyway, guys, not financial advice. I think we're all holding. So, anyway, because there could be a short and distort campaign right now on AMC, right? They're trying to get you to sell by using negative reports about Adam Aron selling his shares, or the end of the year. There's Omicron. There's tax loss harvesting for certain institutions. In my understanding, that retail, across the world, not financial advice, is buying up the stock. So how it continues to go down, I don't know. All right, guys, until next time, peace.